So as Chris mentioned, I was just going to give you a bit of an overview of how I was seeing the M&A sector across senior living and aged care. And I thought I'd just talk a little bit about what's happened in the sector or what's not happened at certain stages. So this is a page with a lot of logos on it. Don't worry too much about the individual logos themselves, but what it does is show larger corporate transactions where these are target companies that have either been acquired or had some form of investment put into them. They're stratified into 3 rows: retirement villages on the top, aged care, and then home care. And just some of the observations. If you look at that top row, the retirement village sector has had pretty good volumes across that period. And you'd kind of expect that from a property segment. It's undulated. There's obviously some impact of COVID and higher interest rates, but generally there's been good volume across that period. I should also say that across to the right, there are some speculated reported deals as per the weekly source, Chris, with a little blue circle on it that haven't been completed, but speculated to be in the market. But I thought I'd put them in there for reference. If you actually then look down to the white space in the aged care and home care sector, there's a couple of deals there, the Ality and Japara deals from Bolton Clark and Calvary, and then in home care, that Oxley Let's Get Care and Hills transaction, which were effectively my home care roll-ups. So those deals were all kind of strategic, intra-sector deals. But by and large, during that period, there was very little transaction flow at all. And if you think about what happened in terms of funding cuts, Royal Commission, COVID, a very significant labour crisis across both those sectors, and then quite importantly, uncertainty around reform, basically kept most buyers at bay. And then what you saw as those events have been left behind and reform outcomes were more clearly known and funding improved and occupancy improved, suddenly you had a very strong volume of deals in both sectors. And so you can see just in the last 2 years and even continuing on into early parts of this year, there's been very strong transaction flow, which has been great. It's been great from an M&A advisor perspective, but it's also great to show that there's a lot of interest in the sector because many of these deals have come from external parties. So on this next page, this goes to actually who's been investing and who's been buying these businesses. And so again, I've laid them out into 3 rows: retirement village, aged care and home care. On the left bucket, I've called that strategic buyers. That's effectively the people in this room, operators, for-profit and not-for-profit operators. The columns on the right are financial buyers, and the first column is private equity, and you're probably familiar with that group of investor, and they're funds that are looking for returns of over 20%, higher risk, and shorter term investment periods, 3 to 5 years. The next 2 columns are a very important group of investors that I've called long-term capital, and that's property and infrastructure funds, pension and sovereign funds, and they are lower risk investors. And they look for sectors that have defensive qualities, that have transparent cash flows and earnings, and hopefully high barriers to entry. You will see that class of investor has almost entirely been focused on retirement villages as a property segment. However, we are seeing over the last 6 months that class of investor, long-term capital investor, is showing strong interest in aged care. It should be said that those investors were interested in the sector prior to the funding cuts and Royal Commission. And in reality, they're reverting back. They're picking up their pens again. And I'm hoping to see that they play more of a part in the sector in the coming years. And really it's been that reform and certainty around reform and better operating and financial conditions that attracted them back. The other thing I would say is the interesting part of this page is that not-for-profit column. I suspect if I did this page 10 years ago, that would be largely empty. And so it's been very pleasing to see the level of activity in terms of acquisition activity coming from that class. Again, 10 years ago, if I was selling a business, I probably wouldn't have even gone out to the not-for-profits, but they've been far more active recently, and many have capital and capability internally to do transactions. Now, just in terms of showing you in an illustrative form how much sentiment has returned, I've got a chart here of Regis' share price that no doubt Linda will be happy with. But so what this shows is Regis' share price over the last 2 years. And if you look at the chart, effectively it doubled in the first 12 months from March 23 to March 24, and then it doubled again. So it's a pretty extraordinary outcome. And if I'll say indicatively, half of that performance would have been largely Regis related. I mean, the performance has been very good. Occupancy has increased from 91 to 96%. Earnings has doubled. But the other half really goes to the earnings multiple, and a lot of that goes to the sentiment around the sector. And if you look at the left-hand side of that chart, and this was, by the way, around the time Bain Capital was looking at buying Estia, pretty much everything in the sector was unknown. And so labour rates, including agency costs, minimum care minutes, the impact of IHACPA and how that was going to work, what the budget was going to do in May, and what was going to happen to RADs in the upcoming task force review. And over time, over 2 years, all of those things largely got addressed through various budgets, the introduction of minimum care minutes, the internal workings and outcomes of IHACPA. And then on the right-hand side, as I said, most of those things were ticked off. Now, it's not necessarily that all those things were ticked off in a highly positive way, but the transparency around those things became a lot more certain, which give investors comfort that they can invest in the sector without a great amount of risk. We talked about, there was a comment about liquidity, the introduction of new liquidity standards. That is the sort of thing that investors get concerned about in terms of changing landscape. But broadly, the sector has largely been de-risked over that period. Now, the next 2 pages, I'm just going to give you my version of what we talk to those long-term capital providers about in terms of the demand-supply equation. Now, you've had this probably 3 or 4 different ways today. The way that we describe it is on the left, you've got the growth in the over 80 and 85-year-old population. So what you can see is that goes from about 5-6% up to 7%. On the right-hand side in the columns, we show the build rate. So these are the net new beds contributed to the sector through development. The white bars are the historical levels. They peaked at about 6,000 or 7,000 and are down to about 1,000, which is about 0.5% of the number of beds outstanding. The blue line is what is implied by those growth rates on the left. And so even if you build out 5,000, 7,500 beds a year, you're nowhere near that blue line. Building out 10,000 beds a year, that would be 100 facilities of 100 beds every year. So the prospect of that happening, I would say, in the next 3 or 4 years is almost zero. But even if you did do that, you'd be still below that blue line. And where that gets you to in terms of occupancy, we flow that through. So we've used Stuart Brown as a proxy for current occupancy of about 94%. and then we flow that surplus of demand over supply through occupancy at both that 5,000 bed build rate and the 7,500 bed build rate. And what you see is you get full occupancy in about 2 or 3 years. So when we show that chart to these long-term capital providers, pension funds and sovereign funds, they kind of pause. And what that does is allow them to take occupancy as an issue off the table, which historically 5 or 10 years it always was. It was one of the first things that we talked about. Now, this is a theoretical kind of calculation. It could be 2 years, 3 years to full occupancy. It could be 4 or 5. But as Ian said before, the gross magnitude of the numbers are undeniable, and I think that's the point. So in terms of the outlook, look, the RV space, there's 3 of the largest 4 operators under process at the moment. There hasn't been a huge amount of consolidation in that space. In fact, it's more been strategic positioning or repositioning of portfolios. I suspect that will continue. It will depend, obviously, on the outcomes of those 3 processes. And I think also, as Chris has talked about today, RV operators need to figure out what they're going to do with their home care strategy and whether they use third party, do it themselves, or possibly buy in that capability. In aged care, I can only see consolidation continuing at pace. There's a bit of a balance at the moment between development and acquisition. I think people generally see development costs and timeframes are so onerous that they're actually seeing acquisitions as easier. That may change, but certainly I think consolidation is going to continue at a rapid pace, and hopefully that long-term capital group of investors come to play in this sector, which I think would be a great thing, a great outcome for the sector. And in terms of home care, I think similar thematics. There is a lot of consolidation at the moment. There is still some regulatory uncertainty that people question, certainly outside investors question in terms of the unification of CHSP and HCP, and also where the price caps get set on the service list. But generally, I think consolidation is going to continue at a rapid pace in that sector. And then also just question in thinking about the changes in the senior living landscape, how many of these operators will actually buy in technology or software that they deem to be a crucial part of their business instead of accessing it from third parties. The last comment I would make is just given the amount of activity in the sector now, which I expect to continue, I think there's a reasonable chance that a lot of people, maybe the majority of the people in this room, will be involved in some form of M&A transaction over the next 2 or 3 years, just given that all 3 sectors are under a huge amount of activity at the moment after, quite frankly, a long period of very low levels of activity. Thank you.
That was excellent, Hugo, and you said you didn't know what you'd be talking about, so we've actually used up most of our allocated time. So that last point that you made was just a quiet thing that you dropped, but it's actually a clanger, that most of the people in this room, you believe in the next 2 to 3 years will be subject to an M&A activity. So you actually see coming forward significant activity in the sector.
Yeah, absolutely, and I think it will be across those 3 sectors, but I think it's also in the for-profit and not-for-profit sector. It feels like the not-for-profit sector is just as active. So, and by the way, the other point I would make is they're the core sectors. Investors are also really interested to see how they can get access to that sector with peripheral services and products, because many love the thematics of the sector, but don't quite have the capacity to invest in the care sector. And so they like to invest in adjacencies, which may be software providers or other equipment providers.
And the other thing that struck me is that you were saying the private equity are expecting a return of 20% minimum.
That's their IRR hurdle, 20% annual hurdle, which really means if they invest for 3 to 5 years, they're for every dollar they invest, they get $3 back. That's the general rule of thumb.
And you had up there Pacific Equity Partners and so on. So they've bought into Opal recently. So that
according to the weekly source, Chris, that's correct. And look, they're a good point actually, because I had them under private equity. That fund that invested is called the Secure Asset Fund, and it's actually more like a core plus infrastructure fund. So I would say they're actually the first proper infrastructure fund investor to invest in the sector in this recent period.
And that would give you great encouragement.
Sure. And I think it's great for the sector as well, because most of the infrastructure funds have very deep pockets and want to invest and want to grow. So I think it'd be great for the sector if they could, attract that class of investor.
And when we met for coffee, you were saying that because you were involved in the Bain Estia transaction, the depth of because I was asking you, how do people in New York recognise that there was this great opportunity? And you said the depth of research they had done before they had even picked up the phone to give you a call was extraordinary.
Frightening. I mean, when we announced that deal, people rang me up and said, how did they get their head around it? Are we missing something? And I said, no. They have boiled the ocean on every aspect of the sector. And I mean, bearing in mind this group also bought an airline out of administration. And so instead of detailed modelling in terms of actually financial statements, they actually get strong commitment that in 2, 3, 4 years' time, the sector is going to be in a lot better position than it was at the time. And it's a bold move, but it certainly so far has paid off.
Extremely well. Okay, can we show our appreciation for Hugo sharing with us?
Thank you.